I'm going to talk about NSA. This is a public storage REIT. Full disclosure, I do own this security. I have been buying the security. This is not financial advice. And with the disclaimer out of the way, Daniel, I did write down a lot of great things here. Of course, there's a ton we're trying to get through today. So I'm going to politely ask you to make sure that I'm moving things around well. And yeah, let's hop into it. Are you able to see my screen? Are you able to see the screen, Daniel?
Yes, I am.
Okay, cool. All right, so let's hop right into it. What is self-storage? People buy properties, put a ton of storage units in them. Consumers then go to these storage facilities to store their stuff. A big use case of this is actually moving companies. So when moving companies move people's houses, there's actually oftentimes a lag period in that. I actually worked for a moving company for 2 years, which is funny. So I did move things in and out of self-storage a lot. Other smaller parts of their business are renting out trucks and packaging equipment, which is not super significant for them. They do get some management fees and things like that based on how they operate their PRO models, which is a joint partnership that they have for some of the properties they manage. But anyways, what we are looking at here, Daniel, one thing we have just been talking about is REITs and how they separate into different categories. So you will have to verify this yourself. This is from NSA's website, their investor relations presentation for March. And this graph is claiming that self-storage not only is the least volatile, but has had the highest return over the past 29 years, benchmarked against every single other type of REIT, which I found very interesting. You can see that self-storage is 17.3% with as low as a 0.75-ish volatility ratio. And if you are listening to audio only, I highly suggest checking out the video to see this. Another visualization of the performance of self-storage compared to other types of REITs. You can see the blue line here is the average 5-year return. And then they took the lowest return over any 5-year period. And I believe this is still over the last 29 years. I have to double check that. But as you can see, self-storage wins out again. So obviously they are selling their stock. I think you should look elsewhere for other analysis of this. But self-storage definitely seems to be a very great REIT option. And we're going to dive more into why that is. Any questions on this, Daniel, before we dive deeper in the report?
Nope.
Awesome. So just a little snapshot of what NSA is. Since they IPO'd in April 2015, they returned 285% share appreciation. You can see their total properties here, as well as a lot of their year-over-year growth. One thing that they advertise a lot is the public storage REIT sector typically grows 10 to 15% compound per year over the last couple decades. And they are definitely have been executing on that since they IPO'd, which is great to see. A lot of what we're going through here, Daniel, is direct screenshots from their actual earnings. So I took the time to actually go through these. We're not going to have to read the mumbo jumbo, which is all their financial jargon. And I actually used ChatGPT to help me with some of these summaries, which is great. But we can see their total revenue for the quarter was around 184 million. Net operating income was 133. Both of those increased respectively. A lot of the increase was due to them acquiring new properties, as well as growing same store NOI growth, although there was some... What's up?
One thing I am seeing there is that their core FFO did decrease 3% year over year, and that's the metric people usually focus on with REITs.
Correct, yes. And this was due to operating expenses going up.
Okay.
Okay, let's see. So scrolling down here just to continue to go through, this is them sharing their occupancy rates. So one thing I found interesting, and they talked a lot about this on their earnings call that I listened to, Daniel, is they saw record occupancy rates for 2021, 2022, which I do believe I have a screenshot of down here. Yes. So what we can see down here for occupancy rates, what they're trying to show is that typical rates are actually high 80%, and we are actually returning to the mean, where a lot of people are saying, oh, their occupancy rates are down. But what they're saying from management side is, look, we saw uncharacteristically high occupancy rates that we've never seen before in the industry during COVID, and we are now returning to the mean. Yeah.
That's actually pretty interesting.
It is interesting. So here's what's also really interesting, Daniel. I got a little nerdy with this math. So I'm like, okay, if they're at an 89.7% occupancy rate and made 184 million in revenue, you could then project that if they had 100% occupancy, they would be at 205 million. You might ask, Jake, why are you doing this math? Well, I wanted to see what the occupancy rate had to be for the net operating income. Keep in mind, this is not net profit. For the net operating income to be flat, literally zero. And I am being a little bit hand-wavy with this math since I'm sure that other things would change. But it looks like they would have to be at about a 25% occupancy rate for these current economics for their net operating income to go to zero. That was one of the things that actually attracted me to public storage REITs. The more research I did, you can go down to 60, 70% occupancy rates and still be running profitably and being able to give some money back to shareholders on these. And this company operates, in my opinion, some of the highest quality self-storage facilities in the country based on their management model and who they partner with. So I have no fear that they will continue to hit high 80s%. And even if they do see dips, they have to dip. Like, you know, the self-storage industry basically has to go under, is what I'm trying to say, for the occupancy rates to go to zero. And as a public storage REIT, the way that they grow, and a lot of the reason why they're seeing this increased revenue, is they are investing and doing debt financing to purchase more self-storage units. So what I found interesting is I wanted to see how they structure these deals. They actually only did $9.9 million of cash on a $160 million deal. They structure their shares really interestingly, Daniel. So they create a special B share class that has a $25 liquidity preference and a 6% distribution on it. And they do that because they don't want to dilute common shareholders, taking words from the actual executives off their earnings call. So if you run the numbers on this and just take the 160 mil as a cash value, since it is an expense to shareholders, they are paying around 11x revenue or 15.4x net operating income. If you assume the 960,000 a square foot at the rates that they're getting per square foot today. We have to keep in mind that they do also tend to increase the sales within stores. So these margins can continue to compress down. I thought that this was a fair value to pay, to be honest, but have to do a little bit more research just to see what other companies are paying to do these acquisitions.
Yeah. Okay.
And let's see. There's not too much here. I'm super sorry. My mouse pad has been really broken, so I'm actually unable to scroll. Okay, we're back. Money returned to shareholders. They did $69.3 million repurchasing of common shares. One thing that I love is they have $240 million left authorized in their share repurchase program, and that's actually about 5% of its current $4.8 billion market cap. This is actually comparable to the Google and Apple share buyback programs relatively. If you do the ratio of the amount that they're buying back into the market cap, it might even be marginally better.
It is.
Yeah, I'm pretty sure it is. I didn't run the math for sure. They maintain
their 3% buyback.
Yeah, they maintain their dividend, which is actually a slightly lower dividend payout than previous quarter because, again, they did buy back shares, so there's less shares to pay that dividend on, even though the dividend amount per share is the same, and is currently yielding just shy of 6% as the stock price moves around. So, yeah, that's a general look at their financials. There's a lot more I can talk about, but, Daniel, I do know that we have a lot that we're trying to get to today. The other things that we could look at is they do break their debt down very well.
The main things that people care about with these REITs is occupancy, FFO, revenue, dividend, and the dividend payout ratio relative to FFO. So what was their revenue growth like?
Their revenue grew. Let's go back up here. The revenue increased to 20.8 million. I did not do the percent change on that, but here it goes. 5.7% growth.
Cool. Okay. Net operating income is up 4.8%. Average occupancy is down 3.8%. Rental income per square foot is up 10%. So how much FFO did they generate on the quarter? 85.9 million. Cool. That's down 2.9%. So I don't know. I mean, it looks like the REIT is holding up well. I don't really see this as like this REIT going under or anything like that. So now talk to us about the valuation. What's it selling for today?
Yeah, so it's selling for $4.8 billion. It is paying about a 6% dividend. My personal opinion on the stock, not financial advice, is I think it's at about fair value right now. The landscape right now in public storage REITs is interesting because they're coming off of the highs from COVID. They're still citing on the earnings call that there's a lot of mismatch between what sellers are expecting buyers to pay for these properties, which they said are slowly being met. So they're finding interesting ways to give value back to shareholders here because they actually do want their deal flow to be higher. So in my personal opinion, I own this stock in my Roth IRA, which is a tax-free account. I think it is a safe dividend stock. Their FFO payout ratio is below 50% and actually went down, even though the FFO is down. They were very open and forthcoming in their earnings call about why that was, which was due to increased property operating expense and interest expense, which we can see right here. In my opinion, in terms of the other public self-storage REITs out there, I think that this company is best poised for future stock appreciation growth, as well as continuing to grow the dividend. I am slowly dollar cost averaging into this, Daniel. I think that depending on what happens with the market, there's a chance for the stock to fall a lot. I think that some other things that investors might be worried about is relative to their market cap, they do have a lot of debt and they do use debt pretty aggressively for expansion. However, if you look at their returns on capital for what they're buying these properties for, they're actually yielding more than the fixed rates on their debt, which most of them aren't set to finish until 2030s. Most of it's fixed income, yada, yada. So seems safe.
I have a couple comments. First, if this company is a company that acquires real estate with valuations going down across the sector, they should actually be getting higher yields on the real estate they acquire, which is a good thing. I just checked out the stock. It looks like it's trading for about 11 times FFO. That is lower than it historically has. The FFO yield is around 10% right now, which means, if they pay a 6% dividend, they want to buy back shares on top of that. They could buy back 3 to 4% organically on top of the dividend, which is good. So I don't know. It looks cheap. It looks like it's holding up. It looks like it could be selling cheap relative to its historical averages.
This is a stock I plan to hold for a very long time. Good management, good dividend. I don't expect this to be like a 10 or 100 bagger, but I do have a strong belief that this has a strong chance of beating SPY returns compound over the next 5 to 10 years.
Yeah, this stock has been beaten hard recently.
Yeah. Oh, yeah. That's one of the reasons why I started buying it. So I started buying this stock lightly at around $40, $41, literally buying 2 or 3 shares at a time. I actually think I went crazy, Daniel, and bought 8 at a time this week when it went down to about $36. But again, these are very slow controlled buys for me. I don't know where the stock is going in the short term, but feel confident on it for a long-term hold dividend play.